If you've been in the real estate market and looking to purchase a home in 2022, then you know that interest rates have been on a stairway higher since the year got underway. And if this increase really makes you wonder how you're ever going to afford a home in your desired neighborhood and price range, then I'm going to show you 3 classic ways you can keep your rate and payment as low as possible, starting right now. Hey guys, welcome to Rockin' Real Estate. I'm Rob Spinosa with Guaranteed Rate. If you're a home buyer, a homeowner, or even a real estate professional looking for home finance tips, tricks, and the occasional cool guitar licks, I've got your Backstage pass to a better understanding of the mortgage business. In both low-rate environments and higher-rate environments, there are 2 crucial aspects to any mortgage pre-approval: how much the lender will approve you for, and how much you feel comfortable affording each month. It's important to keep both of these perspectives in mind when searching for a property and a housing payment that will meet your needs. And more often than not, you end up having to balance the 2. Let's say a lender approves you for a program and a loan amount that has a payment that would be uncomfortably high for your household budget and leave you house poor. Here, you don't have a qualifying issue, but you do have a payment issue. Next, let's say a lender comes back and limits the amount you can borrow to a level that wouldn't even get you into an entry-level home in your desired neighborhood. Here, you do have a qualifying issue, and you may also have a payment issue as well. There are 3 solutions that can help address both situations. Number 1, buying down the interest rate, also known as paying points. Now, we realize the word points is usually equated in the borrower's mind with paying additional cost. And while it is true that buying down the interest rate does increase the closing cost, the exclusive purpose of discount points, and that's what they're technically called, is to provide the borrower with a lower rate over the term of the loan for a one-time investment at close of escrow. Remember that 1 point equals 1% of the loan amount, and there's an easy calculation you can do to determine the effectiveness of paying any amount of points. First, determine the payment savings between the 0-point rate and the discounted rate. Next, determine the cost of the discount points themselves. And finally, divide the monthly savings into the total cost, and the result will be the number of months that it takes to recover your investment. As long as you hold the loan past that time, your investment will pay off. And in the cases where you must buy down the rate in order to qualify, your lender can help you identify the exact amount of cost it will take to get your payment into the range you need in order to qualify. Number 2, choosing an ARM loan instead of a fixed rate loan. I know what you're thinking, ARM loans are scary. After all, interest rates could keep going higher and your payment could keep going up as well. Not exactly true. Most ARM loans today are hybrid ARMs, meaning they have a fixed period at the start, usually 5, 7, or 10 years. So you see no adjustments to rate during that time. So in cases where the qualifying payment on these programs is lower than a 30-year fixed rate, you may pick up additional qualifying power. Oh, and when the fixed rate portion converts to adjustable, remember there is a cap structure that will govern how far and how fast the rate can move up or down. So these are not balloon loans. They don't ever come due all at once. And once you understand the cap structure and the worst case scenarios, you may determine that an ARM loan ideally suits your needs. The data supports that most borrowers, even with the best intentions, will not hold a 30-year fixed rate loan to its entire term. Number 3, let's talk about interest-only loans because we get asked about them all the time. These programs offer a much lower payment because you're only paying the interest portion of the payment. No principal is included as it would be on an amortized loan. That means that even though you're making the payment according to the loan terms, the loan balance is not decreasing during the interest-only period. However, even though interest-only loans will provide you with a much lower monthly payment, they are significantly harder to qualify for. Because behind the scenes, the lender is using a qualifying payment that is substantially higher than the payment you would make once you got the loan. So, getting back to our balancing act, an interest-only loan may be a good fit for those that don't have a qualifying issue, but do have a budgetary one. As we wind on down the road of higher rates, no matter how high they go, there will always be those who need to purchase and refinance real estate. And understanding the options that exist for lowering your monthly payment can go a long way towards expanding your budget and home search possibilities. So if you have any questions about strategies for obtaining a lower rate or a lower payment in an increasing rate environment, or if you have questions about any other aspect of the mortgage process that will get you the financing you need, don't hesitate to get in touch at any of the links below or by calling us directly at 415-367-5959. And if you found today's video helpful, please click on the like and subscribe buttons below, and we'll keep the hits coming.